If you have ever read a Forex article and you get lost by the second sentence, this video is for you. Because today I'm breaking down the most important Forex terms every beginner needs to know. Just plain English, simple examples, and no jargons. That by the end of this video, you will understand the language of Forex trading. So let's get into it. So the first one is currency pairs. In Forex, you never trade one single currency. You always trade one currency against another. And that combination is called currency pairs. The most traded pair in the world is Euro USD, and that is the euro against the dollar. The first currency is the base currency, while the second currency is the quote currency. Here's a real life analogy. Think of it like a price tag. When Euro USD is at 1 or 10, that means 1 euro costs $1.10. When price goes up, it means the euro is getting stronger. And when price goes down, it means the dollar is getting stronger. Number 2 is pip. A pip is the smallest standard price movement in a currency pair. For most pairs, it is the fourth decimal place. So if Euro USD moves from 1.1000 to 1.1001, that is 1 pip. So why does this matter? It matters because pips is how profits and losses are measured in Forex. Here's an example. Think of pips like cents. Just as you measure small price differences in cents when you go for shopping, Forex measures small price difference in pips. Number 3 is a lot size. A lot is the unit of measurement for a trade in Forex. There are 3 sizes you need to know. The standard lot. This is 100,000 units of currency and is mostly used by professional traders. Then we have mini lot. This is 10,000 units and is more accessible. And then we have micro lot, which is 1,000 units and is perfect for beginners on demo and even on small accounts. So here's an analogy. Think of lot size like buying eggs. A standard lot would be a full crate. A mini lot would be half dozen. And a micro lot can be maybe 2 eggs. As a beginner, always start with the smallest size possible. Number 4, spread. A spread is the difference between the buy price and the sell price of a currency pair. And this is how most brokers make their money. Not by charging you a commission, but by slightly widening the price. An example, think of the foreign exchange bureau. They buy your dollar at one rate and sell again at a slightly higher rate. That difference in price, that's how they make their profit. And that profit they make is the spread. Number 5 is leverage. Leverage allows you to control a larger position with a smaller amount of money. For example, with 1:100 leverage, you can control a $10,000 worth of currencies with just $100 in your account. So this sounds amazing, but here's the truth. Leverage magnifies both profits and losses. The same way it can double your gains, that is the same way it can as well double your losses very, very fast. So as a beginner, use a low leverage, maybe 1:10, until you are consistently profitable in a demo account. Number 6 is margin. Margin is the deposit your broker requires to open a leveraged trade. It is not a fee. It's more like a security deposit that is held while your trade is open. But the important thing to understand is margin call. This happens when your account balance drops too low and your broker closes all your trades automatically to prevent further losses. So this is why risk management is everything in Forex, but we'll cover that in depth in future video. Number 7 is stop loss. A stop loss is an instruction that you set that automatically closes your trade if price moves against you by a certain amount. It's your kind of like your safety net. For example, just like a car seat belt, you hope you never need it, but it is there to protect you when things go wrong. So never trade without a stop loss, ever. Number 8 is take profit. A take profit is the opposite of a stop loss. It's the price level where your trade automatically closes once you are in profit. So this is important because without take profit, greed can make you hold a winning trade too long until it reverses and maybe becomes a loss. Just as stop loss protects you from big losses, take profit locks in your gains. So my advice is you use both in every single trade. Number 9, bull and bear market. These two terms describes the direction of the market. A bull market is when prices are rising and the trend is going up, while a bear market is when prices are dropping and the trend is going down. So knowing whether you are in a bull or a bear market helps you decide whether to buy or to sell. So you trade with the trend rather than trading against the trend. Number 10 is liquidity. There are so many definitions for liquidity out there, and trust me, most of them are all correct. But I would say liquidity refers to how easily a currency pair can be bought or sold without causing a big price movement. And we have high liquid pairs and low liquid pairs. For high liquid pairs, they are like the major currency pairs. For low liquid pairs, you can go towards the exotic currency pairs. High liquid means there are always buyers and sellers, and so trade executes very fast and spreads are tight. For low liquid pairs, there are fewer participants, and so spreads are wider and price can move more unpredictably. So as a beginner, stick to high liquid pairs such as Euro USD, GBP USD, USD JPY. They are more predictable and cheaper to trade compared to the low liquid pairs such as the exotics. So these are the core Forex terms every beginner needs in their vocabulary. Bookmark this video, come back to it whenever a term confuses you. So if this helped you, hit the like, subscribe, and drop a comment below which term was most confusing to you before today. My name is Good Hayes, and this is Simple Forex Secrets. See you on the next one. Bye-bye.